Why was this group catching your eye last week?
It felt to me as if this was the last group. This and energy was the group that people that were long basically sort of, I think they just sort of acquiesced and threw in the towel. And I think that's why you saw as precipitous a decline as we did. And you also had some political concerns. There was some rhetoric out of Washington. Obviously, every once in a while, these companies get bullseyes on their back. So I totally get that. I think to a certain extent, I think what the markets realize is, wait a second, there's still some real stories here, and valuations are still compelling. And last week when Merck was down to 84, Karen mentioned on Tuesday on Fast Money that she liked Merck at those levels. You look today, I think it actually traded up to 95. Eli Lilly, I believe, made a new all-time high. Bristol Myers breaking out to the upside. So there are real stories around these companies, and they have compelling valuations, which is in this environment is exactly what you're looking for. So although obviously that move to the downside was rather steep and rather quick, I do think there's value here in these names. Now, the armchair analysts will look at this and say, yeah, a bit of a death cross here. I get it. We'll see what happens, though, if and when we get back through that. I think it's a 150-day moving average, Carter.
Yeah, I mean, it's a tough spot, right? When you break from well-defined lows at a common level, which you've annotated there with that green line, and then you recover to and above the level from which you broke down, by definition, you're back to a difficult level where there's overhead supply. Or said differently, there's memory. Once you break and you're at those lows of 4, 5, 7 sessions ago, you have people who are trapped by definition. Anyone who purchased XLV for the past year is underwater, negative, yes? And the human condition, if given a chance mid-hold to get their money back, they seize it. Many of them. So this strength draws out people from above. Give me my money back. Thank goodness. That's one type of memory, people who bought poorly. And then there's the opposite. The most hapless, dumb luck player at the bottom, or George Soros himself. When you nail something at the low, you flip the cards over and they show you 8, 10, 12%. In sessions, you say, I got to put it out. So you've got memory from below. Let me grab it. That was free money. Memory from above. Thank goodness I'm even. It's a tough spot to rally. But relative, that's the key. I think healthcare's got a long way to go.
All right, talk to us on a relative basis, because you're going to point out some opportunities that you think still exist in the space.
Well, okay, so here are 2 lines, very straightforward, right? It's a comparative chart. You've got the sector versus the market year to date. We know the sector is down 7.8 and the market is down 17. So we're basically 1,000 basis points of differential. And you could say, so what? They're both down. That's true. Money's been lost in either one. But if one is benchmarked to an aggregate and is running money for an endowment or a mutual fund or a family office, it's all about relative performance. Meaning if everyone else has a terrible night and you, the lead scorer, even if your team wins, you did a good job. So look at this chart a different way. The second chart is simply the ratio, the relative line. And that horizontal line is the start of the year. That is actually the alpha depicted by the difference between healthcare and S&P. It's beautiful. It's up and to the right with nice dips. It's quite good. And then just a few more. We have some long-term charts. This is all data. So sector data goes back to September of 1989 for the S&P 500. And this is simply that ratio chart, healthcare's relative performance to the S&P. Now check this out. Put in a trend line. It's incredible. Put in the arrows. It's literally bounced to the penny every time. I mean, healthcare underperformed for about 6 years and came down to that line at the end of last year and bounced beautifully. I mean, what's not to like?
Yeah. So let's hit some of the individual names here, because again, I mean, Guy, you had mentioned Amgen and Lilly last week. You want to look at a few of these, and it's not just individual pharma names or the managed care names, and you're also going to look at some of the stuff in biotech. Let's talk about some of these individual names, because if you look at the sectors on a relative basis, the S&P, like you just laid out, they look like these are some places that kind of put some money relative to the S&P 500.
For me, it comes down to just what's the fundamental story. And the names we mentioned, they all have stories. Amgen, for example, the story there is clearly valuation, probably at current levels trading at 13 times next year's numbers, which, as you know, I mean, in the space, it's very cheap. So I think that alone is worthy of a look. But Eli Lilly is probably the best run big cap pharmacy company in the world right now, just in terms of lower left, upper right. And that's been going on for quite some time. Yeah, there have been pullbacks along the way, but as you can see, pretty much each time we've held the moving averages. And then you look at a Merck, which has been volatile. I mean, Merck had this move from 60 up to 81, back down to 60, got back on its horse, traded back down to 84, as I mentioned earlier last week. And now here we are making a new all-time high right around 95. Again, decent valuations, a story there. They're looking to make an acquisition. So, growth by acquisition and their organic growth as well. So for me, at least, Dan, these names make sense. And Bristol Myers, I think, is the last one we have, which has been on the mat for so long, finally getting out of its own way. We basically just got through a multi-year high a couple weeks ago. And again, valuation compelling. And I like this story. And this is not in a vacuum. I mean, these are names we've talked about now for months.
Yeah, Carter, you just talked about a little the XLV when we were looking at it, and the ones that Guy just kind of ran through a little bit have that kind of spike move over the last couple of weeks. Talk to me, though, about a couple that you think could really break out of bigger bases, because I think you have a chart here of Humana, and this thing looks very different despite the fact that it did have a very sharp move over the last couple of weeks. But if you look at that very long base that it's been in.
That's right. And so you would say, why would one be interested in the laggard? So if you looked at its relative performance to the sector, it's been an underperformer. And that is typically something to avoid unless and until its absolute pattern is good. And that's what this is, meaning you are sitting here at very well-defined tops just below, exhibiting now good relative strength day to day, bullish price volume correlation. Breakouts, the precondition for a breakout is a protracted range, and then you break out, you clear, and you move. This is set up very well. I like it a lot.
All right, so you just mentioned a laggard, and if you look at the XBI here, you have a chart. This is one that is obviously lagged the broad market. It's large cap, peers. Talk to me a little bit about this setup here, because that has been in a well-defined downtrend here, and you think the opportunity is going the opposite way on this one.
Well, that's right. So one could say the lines are arbitrary. You've drawn a trend line that's arbitrary. So forget all the lines. Let's discuss how an early bearish to bullish reversal starts. If you're in a downtrend, and downtrends are punctuated, characterized by counter trend moves up, each time after you have a counter trend move, then the resumption of weakness should make a new low. So the first data point that's incontestable, nobody's opinion, not mine, not anybody's, is when we started to make the new resumption of weakness, we couldn't make a new low. We didn't make a new low. Hence that little double bottom that I've annotated there. And now the strength is above the level from which it sold off when it put in the double bottom. So we have the beginning of a sequence change. Finally, if and as, that's my bet, that we get above, we break out above that downtrend line, then we start to have something that has legs. And we've seen this in so many things. History that tells us, whether it's the KWEB recently or any kind of stock or currency or index or commodity, bearish to bullish reversals start a certain way, and they start by not making a new low. And that's what that double bottom is.